Today, Ether slides more than 1% to start the week, and a certified cryptocurrency forensic investigator weighs in on crypto regulation in the US. Welcome to CNBC's Crypto World. I'm Kate Rooney. Digital currencies largely in the red to kick off the week. By noon Eastern, Bitcoin dipped about 0.5%, while Ether dropped more than 1%. XRP, meanwhile, fell more than 1.5%. Okay, let's catch you up on some of the top stories you need to know about. Montenegro's higher court has approved the extradition of Terraform Labs co-founder Do Kwon. In a press release on Friday, the higher court said the legal requirements for Do Kwon's extradition to either South Korea or the US have been met. Both countries are looking to put him on trial for his involvement in the collapse of Terra Luna, but it's unclear right now where Do Kwon will ultimately end up. Montenegro's justice minister still has to sign off on his extradition after the crypto founder serves a 4-month sentence for falsifying documents. Last, Cathie Wood's ARK Invest is offloading more of its Grayscale Bitcoin Trust holdings. The investment firm sold more than 94,000 shares, or about $3 million worth. In fact, ARK has sold more than 800,000 shares in that trust just in November, according to daily trade notifications from the firm. This latest offloading of GBTC comes as the trust discount has narrowed to its lowest level since 2021. All right, turning to crypto regulation for our main story today, Crypto World's Talia Kaplan sat down with global advisory firm StoneTurn about the advancements here in the US and what more needs to be done to regulate the nascent industry.
You're a certified cryptocurrency forensic investigator with more than 2 decades investigating financial fraud cases. So last time we spoke was during the trial of Sam Bankman-Fried. You noted at the time that the trial presents a huge opportunity for crypto regulation. Here we are, the trial is over, so what do you think is next for crypto, and what was your reaction to that guilty verdict?
Right. So working backwards with respect to the verdict, it wasn't surprising. As somebody with over nearly 25 years of both financial forensic investigations and cryptocurrency, I've seen a lot of fraud, and you can see the patterns, and a lot of the facts coming out both before the trial and during the trial, I think were pretty egregious and really pointed to that intent that you need with fraud. So I wasn't actually very surprised by it. I think, though, the good news is, as I had mentioned previously, that I thought it was a big opportunity. I think the benefits, or what I was hoping to see come out of that trial, did actually come out of that trial, meaning I think the public has gotten to a place, or hopefully gotten to a place, where they know, look, crypto's not evil. FTX wasn't this criminal enterprise, right? It's bad behavior by humans taking advantage of gaps in regulations, voids and cracks in oversight. And so coming out of the trial, I think people are more cognizant about needing to do that personal due diligence, needing to do their homework. And so I think we're starting to see a lot more, institutional investors and everyday investors trying to do more around researching and again, making sure that they understand the risks of what they're about to get into.
Now, when we spoke about a month ago, you acknowledged that lawmakers didn't seem to accomplish enough as it pertains to crypto regulation following the collapse of FTX. So I'm wondering, now that the trial is over, what do you think lawmakers should prioritize as it pertains to crypto regulation and as we head into 2024?
I think what they should prioritize is again, getting behind financial regulation of the crypto companies. In the US, it's regulation, as it relates to financial regulation, it's pretty much a binary path. If it's a commodity, it's regulated by the CFTC. If it's a security, it's regulated by the SEC. And right now, as everybody knows, we're kind of in this uncertainty as to how to classify and how to regulate these assets in the US. But I think it is important to start to continue to move in that direction because, look, if we end up in a place where the SEC takes ownership or takes responsibility over crypto assets or however we're going to classify them, in my mind, the maybe not the single most, but a critical and important component or requirement of the SEC that it places on its registrants is the need to publicly provide or disclose certain material financial information, right? So for example, the business risks associated with your business performance. Do you have debt obligations? What are your investment policies? What's your investment performance? What do your related parties look like? Who are your beneficial owners, right? You need that transparency. And, for cryptocurrency, as I said, like we're putting people in the place where they realize and are taking action to do this due diligence, but there's without that regulated or that required disclosure or that transparency, there's no information, there's nothing, they turn around and there's nothing to look at. And even when they can find information, right, it's either outside their technical capability or perhaps it could even be possibly, manufactured by a savvy, tech-savvy threat actor, right? So really where we should move in substance with regulation in the US is towards a place to bring transparency to the cryptocurrency industry. And it's funny, it's a little bit antithetical to, I think, one of the big benefits that people see in cryptocurrency. But as it relates to regulation and just pure information, the cryptocurrency industry is missing transparency.
In your role as a cryptocurrency forensic investigator, you conduct reviews of digital asset life cycles and you work with investors to identify and isolate digital assets and help with recovery when needed. And so I'm wondering, through your work, did anything jump out at you where you were like, oh my gosh, this needs to be addressed right now in crypto?
I mean, I think immediate is a little bit ambitious given our current situation, but what I would like to see where I think there is a big gap, and even a lot of the current regulatory frameworks that are out there, not just not in the US, but globally, don't necessarily address DeFi, right? So DeFi is decentralized finance, and what it does is it enables people to utilize cryptocurrency in other types of financial transactions. So lending transactions, borrowing, swap trades, et cetera. And those operate through smart contracts. And smart contract is, as I'm sure your viewers know, is just coding that pretty much sets parameters and then executes once those parameters have been met. Smart contracts and DeFi largely don't need individuals or human intervention. They're automatic. Those contracts automatically execute, as I said, and they're fully decentralized. And so in my mind, that's a place where it's hard to regulate. It's hard to figure out who are you holding accountable? What are you holding accountable? Where is this? What is the code? And that's a place where the crime, what I'm seeing through my investigations, is crime in that area rising exponentially. But our ability to kind of hone in on it and truly understand the risks and how to address them is a big gap that I see coming down the pipeline if it's not here already.
So following the collapse of FTX, we have seen some regulatory advancements here in the US. For example, over the summer, lawmakers advanced the Financial Innovation and Technology for the 21st Century Act, which establishes a crypto framework. And we also saw some developments on the stablecoin front. The House Financial Services Committee advanced a bill to establish a regulatory framework for stablecoins. And a few months before that, you actually wrote a piece. It was titled, "Making Stablecoins More Stable." In it, you note that stablecoins are designed to be stable and immune from the price volatility that plagues their crypto brethren. This makes stablecoins an integral part of the crypto ecosphere and an illustration for the use case of digital assets for business transactions, payment systems, and treasury functions. You then go on to answer the question of why stablecoins occasionally become unstable, as we have seen in recent months. Given your expertise and the fact that you wrote this piece, what do you think of that bill, that stablecoin bill? Do you think it will get approved? And do you think it is comprehensive enough?
So getting approved is not necessarily something I can answer just because, it's in Congress, it's politics, and it's hard to know which way that will sway, particularly given the fact that we're about to go into an election year, right?
Fair enough.
So, there could be a little bit of a logjam there. But I do think that that's one, it's an important step, right? Even if the bill, the broader cryptocurrency bill kind of stalls a little bit, I think this is showing a willingness of the US to kind of start taking this more seriously and responsibly, including what's interesting is in the face of some lawmakers suggesting that if we were to regulate cryptocurrency or to establish a framework, we'd be giving legitimacy to cryptocurrency and almost like rubber stamping it and saying it's okay, which I think is a little bit short-sighted. But so I think my point there being that it's a big step forward. It is momentum, even if it's not fully where we need to be. And what I also like about the bill is that it starts to address the proof of reserve audits, which I think are critical to the stable coin industry. If we are to trust and rely on these and really more fully integrate them into our financial system as a mechanism, as a settlement currency, then these proof of reserve audits will become critical to being able to trust those reserves.
Curley also discusses international crypto regulatory advancements and reveals what region she thinks is going to be winning that race. You'll be able to watch the full interview over at cnbc.com/cryptoworld. All right, that's it for today. We'll be back again tomorrow with a lot more. We'll see you then.